Today, my guest is Lee Kearney. Lee is one of the nation's most active and successful single family real estate investors. He's flipped over 7,000 homes in the last decade, and that totals over 500 million in property under his SPIN real estate company. In just a minute, we're going to speak with Lee about understanding the real estate market cycles and how to find opportunities in any market. Hopefully, we'll also get a chance to talk with him about creating long-term wealth in real estate. But first, a quick reminder, if you like the show, CREPN Radio, we would love to hear from you. You can like, you can share, you can comment. And like I said, we would love to hear from you. Also, want to remind you, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and that's Commercial Real Estate Pro Network on YouTube. With that, I want to welcome my guest. Lee, welcome to CREPN Radio.
Thanks for having me.
Lee, I'm excited to speak with you today. And before we get going, if you could take just a minute and share with the listeners a little bit about your background.
Sure. My name's Lee Kearney. I'm originally from Dublin, Ireland, just outside of Dublin. So I was born there, lived there 17 years, moved over to the States, went to school, got my degree, got my master's. And while I was doing my master's, I actually started doing real estate. I'd flipped a property in between my degree and my master's by accident. I bought a home in Ireland, didn't like it, got broken into, so immediately put it back in the market, sold it, and at that point, made more money than my current job at the time. That was 16 years ago. And so that's when I got the itch for real estate. When I moved back to the States, I decided I was going to do real estate. And as I was finishing my master's, I was going to school by day and rehabbing by night, and flipped a couple homes in California and started doing it in Tampa, Florida when I moved back to Tampa. And since 2005, been flipping homes out of Tampa, Florida. And now we're buying and selling nationwide. So it's been quite a journey. There's been some big blips in the road. I know one of the questions you often ask your guests is risk. And I'll tell you, in 2007, 2008, I lost everything. The market tanked. And so, that's fresh on my mind as I see us going through this next mature stage of the market, I guess, for lack of a better word, where there's been rapid appreciation. So I've been there, done that. I lost everything 12 years ago.
Well, that's a lot of up and down that you've experienced. In 2005, when you first started, I'm trying to remember where the market was. It seems like there were no real warning signs of anything. Essentially,
there was.
There
really was. And I'll tell you, when I looked back, they were handing out a loan to anybody with a pulse. In fact, they were handing out loans to people that didn't even have a pulse. So knowing what I know now, when I saw how loose lending was, I now know that indicates being at the end of the cycle. So that's definitely a big problem. And so if I had known what I know now, I would have realized we're at the end of the market cycle.
You went through the 2005, you saw the peak where there was a lot of free money, if you will.
Yeah.
And like you said, hindsight is the gift you have today that allows you to recognize that was kind of the thing was overcooked kind of thing. How do you compare that to today's market?
It's interesting you mentioned that. I use the term an efficient market for this market cycle. And what I mean by that is that assets that are trading high for a reason, and assets that are trading low for a reason. And that's because they have learned a lot of those lessons as far as just lending money to anybody on anything. There was a lot of mortgage fraud regarding appraisals and things that are just completely crazy, where I remember seeing one of the biggest scam artists here in Tampa, Florida, who actually went to federal prison for over a decade. What they would do is buy these old, big homes. They would paint the front of the home. They wouldn't even rehab the home, do a drive-by appraisal, and pull out 3 and 4 times the amount of money that they'd paid for these homes. And so those kind of scams were prevalent nationwide. And so it wasn't an efficient market. Everything was trading high because people were taking advantage of that loose lending. But now what I'm seeing is that, again, stuff is trading at a certain price for a reason. There is no free lunch, which means, there is no undiscovered asset class. Everything's trading at a price for a reason. And I think that what's going to happen next market cycle is that it's going to follow a more traditional cycle. And what I mean by that, If you look at FHA defaults, they're typically 3-4 times what a conventional default rate is. And so we're targeting for next cycle FHA heavy areas that have been bought the last couple of years. In other words, buyers that are at the peak of what they can pay for a property as far as affordability, that are maxed out, that are paying right at the end of the market cycle, that I believe are going to lose these properties in the next 2 to 3 years once the market flips.
Got it. So and this is something I think that's interesting when I talk with people that kind of study the cycles and the causes of, a crash or whatever. And there's something I was reading the other day or watching, can't remember where I heard it, but it was about of all the recession, the dips in the market. Clearly, the Great Recession was massive. But as far as the cause of the different cycles, it's in 70 years, as far as I understand, the only time that it was ever caused by real estate was the '08 crash. And so I'm wondering when you look at, I mean, that was certainly a unique time, and money was loose. People there, the home uh, mortgages were kind of the free money that everybody was getting, and just everything you just said is that it was basically if you could fog a mirror, you could get a loan. The fraud that was in I mean, on the lending side, where the appraisals and all that fun stuff. So all of that's been tightened up. So how? I think what you were talking about, the affordability kind of thing, is the thing
Yes.
that I wonder if you can kind of expand on that as far as what you see in hindsight and where you think that might go.
Sure. So I'll give you an example. If if an average person can afford a $1,200 a month payment, either if the price is at a certain point, if the price goes up, the rate needs to come down to keep that payment at $1,200. At a certain point, with the price keep going up and up and up, you can only drop the rate a certain amount. And now the feds are doing that. So at some point, that payment becomes unaffordable. So you can't keep having prices going up because you can't keep lowering payments. In fact, the feds started to reverse that trend this year and have already made 2 price drops on the Fed funds rate, which is a 1/4 point and a 1/4 point. And that's gone from 2.25% down to 1.75%. And just to give you some perspective, in 2008, when the crap hit the fan, the Fed funds rate was dropped to 1/4%. So people always ask me, well, how low can rates go? Well, it looks like they could drop quite a bit further. And so that's a tool that the feds use. And if you want to just use an example, look at Las Vegas, look at Tampa, 2 bellwether markets for real estate, and just type in Zillow, Tampa market. And you'll see at the end of 2018, when the feds raised the rate for the last time in the last 12 months, it tanked the market. The market literally started taking a nosedive, and you can clearly see that it was on an upward trend. So now what they've done is said, okay, whoa, the prices are high. We need to start dropping the rates in order to breathe some life back in the market. But that's just, it's an end of the market tool. Yes, it provides liquidity. Yes, it keeps things going, but the prices have risen to a point that in most primary markets, an average home is unaffordable. Now, there are exceptions to that, and what you'll see is that investors are chasing those markets, but at some point, things need to reset. Does that mean they're going to crash 50, 60, 70% like they did last market cycle? Perhaps not, but investors buy when they think properties are going up, because now you've got to hit a point even for investors with cap rates being so low that they need to have appreciation. So if they see no more appreciation in the market and they're not cash flowing, it means investors are going to stop buying. So investors stop buying, prices are unaffordable, defaults start kicking in. All of this works together, and economics 101 with supply and demand, where you've got now a supply of properties coming back on the market from distressed sellers. You got the demand taken out of the market because investors are not feeling very bullish about real estate. You combine those 2 things together, that's going to drop the price. And so it doesn't have to be a global collapse. It's just a normal market cycle in real estate where prices do need to reset. Now, a lot of people will argue with me and use averages to say, well, real estate went down 1% last cycle, but the averages don't tell the true story. There's markets going up, there's markets going down. This is where you need to look at what kind of a market you're in and look at the historical pricing. You take Tampa, Florida, for instance, It was up here. It crashed down here. In fact, the median price in Tampa, literally 10 years ago, was 1/3 of what it is today.
Wow. What was the
1/3.
peak? What was the peak before the crash?
The peak was about mid 200s, and then
Okay.
it went down into the 80s, median price in Tampa, and now it's back up in the mid 200s.
Wow.
That's a fact. People,
Yeah.
that's where using an average or a national average for housing is a very, very dangerous tool, because that average does not capture the fact that the market was literally 35% of what it is today 10 years ago.
Right. No, I love the fact that you're focusing on the payment, because I think that's something I realized when we bought our first home was that, we were stretched to the max back. I can remember thinking like, we can afford that. What about lights and food? And, how are we going to pay for the rest of this stuff, and, and then very shortly thereafter, the mortgage rates dropped, and I talked with a friend. He said, yeah, why don't you just refinance? You get a lower payment. I was like, oh, okay. And
Yeah.
all of a sudden, you felt like you had more spending money.
Yeah.
But like you said, what I realized right away was that relationship between rates and price had nothing to do with payment, because payment was the piece that couldn't change because people they didn't have additional money to spend on that.
The two things that typically cap out a market are the payment and the cap rate for an investor. At some point, the cap rate's going to fall down to a price that it doesn't make sense. If you look at a market like Tampa, an average investor is going to struggle to make 5 or 6%, which is not an attractive rate. If you're paying 4 on a good day and you're pro forma on a good day making 5 or 6, that's a really thin spread. Now it gets into things like covering your debt coverage service ratios. That's going to be a real hassle. So then investors start handing back properties because they can't afford to make their payments because a tenant moves out or tenant trashes the home. And now they're going to give up 2 or 3 years yield or more just to do one turn on the home. At some point, it doesn't make sense for investors. And people say, well, they put 20% down. How long is a mom and pop investor going to keep putting money into a home when they can't afford the payment? At some point, people throw in the towel. And it's the same point. If you take an FHA buyer buying at the peak of the market, completely maxed out on payment, now their AC breaks. They need a new roof. They're basically a glorified renter that has now stepped into being a homeowner. And the true cost of home ownership is seen over years and typically not over months, because you're in the honeymoon phase where you bought a new home, everything's working, it's great. Your payment is less than your rent and life is great. But the reality of home ownership is that stuff breaks. And if you're maxed out, and you made that point, we're talking $50, $100 swings the needle every month. That's where those FHA buyers, who by nature have a higher debt to income ratio, so that higher DTI is why they can only qualify for an FHA, are basically straddling the fence of being able to just afford their mortgage.
Right. No, it's just a delicate balance, and I think that what I've tried to understand is the wage, because I think that the alternative to that is if prices are going to continue up and you want the thing to keep going up, you've got to have more income to do that, which there's such a pressure to keep wages down for inflation.
I just did a presentation on that, and it shows the home price appreciation over the last 10 years. Again, don't shoot me if I'm off by a couple percent here. It was approximately 80% increase in HPA, home price appreciation. You know what the wage growth in the same period was? About 20%.
Okay, well, that's more than I would have thought even. I mean, just based on...
But that's a problem. That's a big problem.
Yeah.
You can't have home price appreciation going up 4x what wages have gone up. So you've made that point, and your point is it's true. At some point, wages have to catch up, and they're just not catching up. And so people sometimes listen to me and say I'm being doomsday. I'm just pointing to facts. Fact. Prices 10 years ago were 1/3 of what they are today in Tampa, Florida. That's a fact. At some point, prices can't keep coming up because they're unaffordable, where an average family can't afford an average home. At some point, cap rates can't keep going down. And the only way to stop cap rates going down is that rent goes up at the same rate as prices go up, which would keep cap rates stable. And that's not happening because
Right.
wages aren't going up. So people can't pay 3 times the amount of rent today that they were paying 10 years ago. I mean, these are real numbers. And so I think a lot of people, are bullish about real estate because they want to get in the game. They can get a loan. They see that they can make some cash flow. They hear that real estate's the way to wealth. But what they're not taking into account is the market cycle. If you're in a cyclical market like Tampa, Florida, basically anywhere in California, Arizona, Nevada, I mean, these are prime examples of markets. Atlanta, Georgia, that's a real hotbed in the South as far as investor liquidity, buyers, sellers, everybody's investing there, and that's a massive market. Those markets are primed for a reset because there's too many people, there's too much influx of capital, which has driven prices up. So you got homeowners competing with investors, competing with institutional investors, competing with iBuyers, and that natural demand or the excess demand is going to force prices up where the market value exceeds the intrinsic value. And that's what's happening in most primary markets. Prices just don't make sense anymore.
Right.
Las Vegas, by the way, poster child, just like Tampa, Florida, homes went from mid 200s down into the 80s, back up to the mid 200s, almost the same market cycle exactly as Tampa, Florida.
I did not realize that the two were kind of a mirror image on that.
Mirror image. It's crazy.
Makes sense though, I guess, if because I think the other side of that, I mean, supply and demand. I mean, housing is just a basic need, right? So if you're buying for shelter, people are still going to need to be housed. I think that what I think also happened in the last cycle was how much of the buying was speculation. Like you mentioned, everybody gets in when, I forget what the saying is, but when I think there was Joe Kennedy years ago, when you're getting stock tips from your shoe shine guy, that's probably a good time to get out of the market.
Absolutely. And one of my mentors put it really well. He said at the end of the market cycle, that's when the dumb money comes in. And he refers to those people, and forgive me, he calls them the masses of asses, come in right at the end of the market cycle. And he said, don't follow the dumb money. Make sure that you're looking ahead in the market. And also, he made another good point. At the bottom of the market, you're an investor because there's clear appreciation ahead. At the top of the market, you are a speculator because the chances of prices going down are actually far exceed the chances of prices going up. And that's why it's important not to call the bottom of the market, because there's plenty of room for growth, but it's extremely important to call the top of the market. And that stuff has been drilled into my head. And after personally experiencing this 10 years ago, I'm very cautious at buying anything. I want to make sure I beat up a deal today that there's a high capex, so I overestimate my rehab, I underestimate my resale price, and if it still survives that exercise, then I'll buy the asset.
Yeah. So when you mentioned in the crash you lost everything.
Everything.
What was everything at the time?
It was about a $2 million loss, and so
okay.
I'd made and lost $2 million in 2 years because I bought at the end of the market cycle, rode the market all the way up through 05 and 06, and then 2007 just flipped the other way. And just to give you an extreme example, and this is one I use just to describe how severe this market crash was. I bought a condominium for $100,000 that appraised at $140,000. This is in 2007, at the beginning of 2007. Then I took out a loan for $70,000. So I'm thinking I'm the world's best investor. I got a 50% LTV loan. What could go wrong? Fast forward 2 years later, that asset was short sold for $20,000.
Wow.
People, I've lived through this. I've seen this and I've experienced it. And the data, that's why I pointed to some easy sites for people to look up, and you can play that game. Just type in Phoenix market, Zillow, and you'll watch the last 10 years. It's crazy. It's absolutely crazy to see what's happened. And it shows you how quickly people forget.
Oh yeah, no, it is absolutely just kind of a crazy phenomenon that people can be so damaged and then so easily forget just about how severe it was. I'm curious.
I will say, go ahead.
Go ahead. Go ahead.
I was going to say now, Detroit, Michigan, I just bought a home yesterday for $35,000. That's a 2,000 square foot home, newer build home. So when I say it's an efficient market, not every market is the same. Assets are trading low in that area for a reason, high crime, it's a tough place to rent. And so not every house is going for top dollar. It's these primary markets that are investor driven markets are going through the same cycle they did last time.
Right. So, I like the way you framed it, that at the bottom of the market, you're investing, at the top, you're speculating. So based on what we've discussed on the cycle that you've experienced, the up and the down, fair to say we're at the top and this is a speculator time? Is that, unless you can beat up
I
a
would
deal?
say in Tampa, Florida, my answer would be in Tampa, Florida, absolutely yes. Okay. But you go to Dayton, Ohio, you buy a house for 10 grand.
Right.
Are you speculating? I don't know.
Right.
You buy it for 5. If there's not a whole bunch lower that home could go. There's definitely, I'm seeing though in most primary markets, and that would be my statement without being too general and just creating a broad stroke over the entire market. Most primary markets that I'm looking at appear to be overinflated.
Okay. And with primary markets, one thing you constantly have is there's growth. There's, at least that's kind of one of the predictors. So you've got a supply of demand. Whereas when you get outside some of these other markets, I don't know Dayton, Ohio that well, but I know as you go into a lot of that, I grew up in the Midwest, and I know that the cycles are relatively flat. There's not a, people get excited if the valuation went up, $3,000 a year. Mm-hmm. And they get, cranky if it goes down $3,000 a year, right. Whereas on the coast, you're talking from mid 2s to 80. That's that's an, oh my God, kind of a thing. So I guess what I wanted to frame, if we could. So we've talked about the high when you were riding up through the 05, 07, the crash down to the bottom, getting in. Can you speak a little bit to the bottom of the market and recognizing, because I think that as we've kind of framed what the top looks like when money is loose, people are struggling to afford, there's no additional up available. The flip side of that is when people lost things, like you said, that investors are no longer investing, people can't afford, they hand back the keys, whatever it is, but there's this oversupply, there's not enough buyers in the market. What is it that you look for, or that you're looking forward to, and how do you frame that? Because I think a lot of times people get stuck in the rear view mirror as opposed to looking forward, and that the market tanked, why would you get in, kind of thing. That's that mentality kind of thing.
Sure. Well, Warren Buffett would give you a very good answer for that. He's got multiple quotes on, blood in the streets, people running for the hills. That's the time to jump in. And you see the same thing in the stock market, by the way. You see people jumping in when a stock is hot, but what happened is the average person jumping in a stock when it's hot, it means investors have already bought in at a much lower basis and have ridden up. There's a huge appreciation that's already happened in that stock. Same thing in real estate. So the time to buy is when real estate's not hot, when prices are depressed. And I'll give you a real life example. Back in 2007, I was selling homes for 150, 160, 170, 180,000. 2 years later, I'm watching these same homes come through foreclosure auction for $30,000. So for me, I could see the bargain. It's the exact same home. In fact, I've bought and sold the same home 3 times. That's my record.
Wow.
So I remember seeing this home going, I rehabbed this house. I sold this house for 180,000. Absolutely, I'll buy it for 30, 40, 50, 60, because it's a bargain. And so I lived through selling at the peak and then buying at the bottom. So for me, recognizing that opportunity was really easy. It was just because I had an apples to apples, literally the same asset, sold for this price, bought for this price.
Right. And in that case, you literally, you knew the property, you knew the market. It was not a struggle to reconcile the numbers. Correct. You knew that you were getting a deal, right?
I knew I was getting a deal because I'm buying it for 1/3 of what I just sold it for.
Right.
Same house. Not even another house, like the same house.
Right. Well, and in that, was there any concern that the market had gone down? How much lower could it go? Or did you feel like there
So
was,
yes, there was, but I also recognized that I was getting a bargain compared to what I sold it for. So there was a huge fear because I'd lost everything. So I took a dual track approach, which is where I wholesaled a lot of homes and I
Mhm.
started slowly buying homes to see if prices were going to go lower. And to your point, prices actually went through a fluctuation between 2008 and 2011. In fact, they dipped even a little bit lower in between that period of time. And prices really didn't start turning the corner till about 2011, 2012.
Got it. Um, so the high and the low, I mean, those are the two, you know, uh, literally the high and the low. What is it that you look for, or are those basically the 2 points you have to be aware of? I mean, is there, if you're buying at the bottom and you see things going up, is it in a healthy cycle, I guess, because the buyers have left the market, now it's just the investors getting in? At what point do you recognize there's a change at the top that the market is,
I think that just opening your eyes and looking at what's happening in the market, if
you know,
real estate is on fire, it's peak. I mean, stuff is going for a lot of money. You talk to an average person, they're saying, yeah, that house is expensive. So the oversupply of money has created an over demand. So it created too many investors. And so that is forcing the prices up. Again, economics 101, all things being equal. If you have excess demand, that's going to force prices up. And that's what's
right,
happening. The
right,
demand for real estate, it's investors competing with institutional investors, competing with the iBuyers, competing with homeowners. Everybody's competing for the same house in primary markets, which is forcing prices up. And the facts reflect that. If you look at the market appreciation, it's almost been a straight line since 2012.
yeah.
Massive supply of money in the market.
Got it. So let me ask you, you've mentioned the two markets that you point to as bellwether, Tampa and Las Vegas. But yet it sounds like you just purchased something in Detroit. Um, One of the things that I've been had kind of a front seat view to observe is a couple of my clients that have always made money in any market. Um, but a lot of what they've the reason why they've been able to is they've not been just in one market. They've been able to recognize that different markets have different cycles and different timelines. Um, can you speak a little bit to how you are pursuing, you know, properties right now? I mean, as far as based on you've
Sure.
mentioned that the Tampa market specifically being overheated. Where are you looking for the opportunities now? Is it Detroit?
We buy nationwide, but
Okay,
what we do is we restrict our risk by buying stuff that's in a liquid market where there's buyers and there's sellers, stuff that we can buy below market value, and it's got to be a newer built home with very cosmetic repairs. So that's our buy box. We'll buy anywhere nationwide, but it's got to be newer so that we can corral what the repairs are going to be. It's got to be cosmetic rehab, and we've got to buy it below market value. So as long as we're buying wholesale in a liquid market and it's a newer home, I'll buy a house anywhere.
you mentioned liquid market. Can you define what a liquid market is?
Sure. There's buyers and the sellers. There's liquidity. Properties are
Okay,
moving. Days on market are low. That if you put something in at a market price, there's a buyer for it.
gotcha, gotcha. Hey, I want to touch gears or touch on the another topic with you is just your belief in creating long-term wealth
Sure.
using real estate. Can you speak to that a little bit?
Well, absolutely. A lot of investors are falling in love with the wrong metrics right now. So they're talking about the number of doors they own. And that's a very risky metric to measure your wealth by. My question always is, what is your equity and what is your cash flow? And both need to be considered. It's very dangerous if you're going to buy a property and hold it for long-term wealth if you buy it with no equity, because prices have to go up for you to have equity, and there's a good chance they're going to go down. And which means, especially if you're buying today, now 10 years ago you could throw a dart, basically buy any piece of real estate, in any, so if we take primary markets, you take the top 10 primary markets, you bought a property 10 years ago with no equity, the market saved your butt because prices went up, which means you would get equity. A lot of investors then focus on equity, but are not focused on cash flow. And the problem with that is you can't sustain owning the asset. At some point, if you buy something with negative cash flow, you keep buying properties that have negative cash flow, you're not going to be able to service your debt. And so if you bought right, the good news is you can sell because you have equity. But if you buy at the peak of the market, prices go down, which means your balance sheet's upside down, and you've negative equity and you've negative cash flow, you're done. You're out of business. There's just nowhere to go. So my advice to everybody, you always want to buy at wholesale, and you always want to buy where there's clear cash flow, which means you've got to really understand your costs on a property and not just be using Google what property costs are and pro forma numbers that don't make any sense. And realize that, if you're going to be in for the long haul, you've got to buy with equity, you got to buy with cash flow. You have to have both. Both are non-negotiable.
You mentioned cash flow. I know I'm guilty of this. The first rental property I bought, I thought just because I could cover the mortgage that I was cash flowing. How do you look at that as far as cash flow? What are some? I mean, if you just had to do a back of the napkin kind of an expense for a, and you primarily still deal in single family homes, is that right?
Yes, correct.
Okay.
I would say that you take $1 and you take 55 cents of that. That's what you're going to net.
Okay. And is that including the mortgage, or is that the,
No.
Okay. So the dollar, so 55 cents is, so 45 cents is what you would reserve for expenses, not
All the
including the
expenses
mortgage,
related to that. Yeah.
not including the mortgage.
Yeah.
So
The numbers are quite shocking. I think people would disagree with me, and you'll probably have a range of 55 cents to about 75 cents, depending who you ask. But I've owned properties for a long time. And so for me, just to be very transparent, I sold over 300 units in the last 2 years because I bought them low. So I cleaned out my rental portfolio.
no, you're selling at the top, right? I mean, that's the
my
whole
belief.
idea. That's
my belief.
Well, that's investing too. And I think sometimes, people get caught up in the, it's going to go higher, as opposed to how much is a good profit as opposed to a bad loss.
Yep.
If you can, if you are a trader and you're getting in and out of the market, the object is to buy low and sell high. And, like I said, I think so often the case is that people are investors or quote investors are basically followers. They're the herd, and they basically get slaughtered when they think the market's going to go up when actually it's getting ready to go down. So,
Yeah.
got it. Hey Lee, if we could, I'd like to shift gears. Before we started recording, I mentioned to you that by day I'm an insurance broker, and in insurance we work with our clients to manage risk. And there's a couple of different strategies we typically employ. The first is we look at, can we avoid the risk? Second is, can we minimize the risk? And then the third is, can we transfer the risk? And that's essentially what an insurance policy is. And as of late, I've been asking my guests on CREPN radio if they could take a look at their investing strategies and how they basically see the market, and if they can identify what they consider to be the biggest risk.
Sure.
And with that, I'd like to ask you, Lee Kearney, what is the biggest risk?
If you're buying an asset today at market value, your biggest risk is the market risk, is the risk of that asset going down in value. Now, if you're buying at wholesale, you don't bear the same risk. But if you're buying at a market price today in any primary market, I would say your biggest risk is that asset's going to go down in value.
No, that is a real risk, because if you're not buying for cash flow and you've got you got your expenses covered and you've got a safety margin there, that is you're taking a big risk, and if you don't have enough reserves, you could end up losing your your investment there. So I get it. Lee, where can the listeners go if they'd like to learn more or connect with you?
Sure, absolutely. Our main website is realadvisors.com. That's real, REAL, advisors, ADVISORS, realadvisors.com. So that way you can learn about what we teach in real estate, and absolutely you can go there and you can learn more about me and what we do.
All right. Well, Lee, I can't say thanks enough for taking the time. I've enjoyed talking and learned a lot, and hope we can do it again soon.
Sounds great. Thank you for having me on the show.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.